Topic 1. Easing Iran tensions, and reports the U.S. will allow Iran to sell oil sent Brent below $80, fueled a relief rally that cut Wall Street's fear gauge, lifted defense stocks in South Korea, and influenced traders' positioning. Summary 3 to 4 lines. Reports that Iran tensions eased and the U.S. will allow Iran to sell oil sent Brent briefly down to the high 70s, sparking a relief rally across financial markets. Volatility fell, equities rebounded, and traders reduced protective hedges. Large IPOs also helped sentiment. South Korean defense stocks jumped on expectations of resumed Middle East exports, but full normalization of routes and supplies will take time. Details: expectations of a de escalation in Iran and reports that the U.S. would immediately allow Iran to sell oil pushed international crude prices sharply lower, with Brent falling at one point to about $78 to $79 per barrel, a 3-month low. Prospects of the Strait of Hormuz reopening triggered the drop in oil, but shipping companies cautioned that full route normalization could take weeks. The oil price plunge and easing of geopolitical risk produced a relief rally in financial markets. The volatility index, VIX, moved below its long-term average and stock markets, Nasdaq, S&P, etc., rebounded. The ability to digest large IPOs, for example, SpaceX, also improved investor sentiment, and options market positioning shifted as protective put hedges were reduced. South Korean defense stocks surged on hopes that an end to the conflict would restart Middle East exports. Hanwha Aerospace rallied as much as plus 11.8%, Hyundai Rotem up to 12.7%, and LG and aerospace parts suppliers approached daily limits. Analysts said negotiations with Israel, Saudi Arabia, Iraq, and others that had been paused could resume and accelerate order realization, e.g., K2ME 250 K2 exports discussions. Overall assessment: news of an Iran-related agreement had immediate and visible effects on oil, financial markets, and defense equities, but details of the agreement and the timing of route and supply normalizations lag. Real economy relief, fuel costs, airfares, consumer prices, is likely to emerge gradually. Topic 2. Central banks and policy divergence are prominent. The Bank of Japan is hiking rates toward a 31-year high and signals more to come. The ECB vows continued vigilance against high inflation. Brazil plans another rate cut, and the IMF warns risks are high even without a clear global slowdown. Summary 3 to 4 lines. Central bank policies are diverging. BOJ and ECB are tightening. Brazil is moving to cut, while the Fed, BOE, and RBA are more on hold. The BOJ raised rates to a 31-year high and hinted at more, and the ECB pledged an active stance against persistent inflation. The IMF warns that risks remain elevated even without clear global slowdown, implying policy divergence will affect capital flows, and emerging markets. Details: key points and implications. Central banks and policy divergence focus. The Bank of Japan (BOJ) hiked its policy rate by 25 basis points in June, from 0.75% to 1.0%, bringing it to a 31-year high, and signaled the possibility of further increases due to inflationary pressures and a weak yen. The European Central Bank (ECB) said it will remain proactive in monetary policy to curb persistently high inflation. In contrast, Brazil's central bank has turned to easing and is preparing another 25 bp cut to a next target of 14.25%, highlighting clear policy divergence among major economies. The Reserve Bank of Australia, RBA, kept rates on hold at 4.35%, but warned additional hikes remain possible. The U.S. Federal Reserve and the Bank of England are expected to hold rates at their meetings this week. The IMF warned that, despite shocks from the Middle East, Iran conflict, there are not yet clear signs of a global slowdown, but risks are high. Rising energy and food prices are straining inflation and capital flows to vulnerable countries. As a result, monetary policy across major economies is split, tightening